Hello my fellow freedom builders and welcome back to the channel. Here in the times where we have a stock market that just seems to keep going up and up and up. And that is what I'm going to talk about today. The title here is if the market will crash. And it will. Yes, the market will crash. However, I cannot tell you when. I cannot tell you if it's going to be tomorrow, next week, next month, or in 3 years from now. But we will see a crash at some times. And all the gurus out there are saying that you should buy gold and you should build a survival bunker. And right now we are going in a deep black hole. But they don't know. And I don't know. However, today I am going to look at some of the things we should be careful about. Because this is not a doomsday video. Because I don't have a clue as to when a crash will occur. But I do have a clue as to how to position yourself in the market, how to take the right risk when we are in a market like this. So that is what the video today will be all about. But first of all, remember that every 2 weeks I'm giving away a 1 ounce silver coin like this, and all you have to do is put a comment in the comment section below. What do you think of the video, ideas to new videos, and so on and so forth. I try to answer all of the comments down there. Also, watch the video to the end, subscribe to the channel, like it, hit the bell notification, all you can find down there below. So remember, every 2 weeks we are giving away these coins. All right, let's get straight into the topic for today. Right now we have an S&P 500 index that just keeps getting new all-time highs every single day almost. And I can feel this euphoria coming in. Also some FOMO, fear of missing out. People are running towards it. They are leveraging their money and so on. And what I'm going to tell you about today is where I think we are in the market cycle and what to be careful of. Because I'm also buying stocks right now. I bought some just the other day, yesterday and the day before that. So I'm buying stocks. But I think we are at a certain point in this economic and stock market cycle. And if you watch to the end, I think you'll be a lot more clever as to where to position your money right now. So let's get straight to it. First of all, I can see right now in every Facebook group I visit that people are trying to get in on stocks, but I can also see that people try to short stocks. Maybe short Tesla or short some of these really hyped stocks. And just a word of caution here. Do you remember this old quote from John Maynard Keynes? Market can remain irrational longer than you can remain solvent. What does that mean? Well, that means that it might be right that right now there's not maybe any reason for the market to go up. We could give all sorts of reasons. It's a low interest rate, it's a Fed printing money, and so on and so forth. The TINA concept, TINA is short for there is no alternative. So people are pouring their money into the stock market. That is true, but some people start to short it now. The thing is that if you start to short the market now, it can actually stay irrational. If you short and short and short, you end up spending all your money and getting margin calls here because the market can keep going up. Even though we can sit here and think, that is not logical, doesn't matter, the market can keep going up. We don't know if it'll turn down tomorrow or next year or in 10 years. So be careful not to short the market here. But also be careful not to fall into the trap that I call the Jesus syndrome or the Jesus trap. Be careful not to think that you can walk on water, that nothing can fail. Because the second you do that, we often start to over leverage and take some risks that we normally would not take. And that is the reason where at least us retail traders really empty our accounts very, very quickly. A good old quote is, it is easy to confuse genius with the bull market. And right now, oh boy, am I seeing a lot of geniuses in Facebook groups. People that have $1,000 in the market or people that have only been in the market for a year or two and they actually think that they are geniuses because everything they have touched since March has gone up. If it is in the stock market anyway. So be careful not to try to confuse genius with the bull market. Try to tell yourself every morning you start the stock market that the reason you have made money since March is not because you're a genius. It is because the market has gone up. Warren Buffett said it very well some years ago when he said that it is only when the tide goes out that we see who was swimming without any swimwear on. And that is so true. When the market starts dropping 10, 20, 30%, that is where we can see who is really good investors and who were only riding the bull market. All right, enough with the quotes. Let's get to the lessons here for today. First of all, I'm going to look at some indicators showing us where we might be in this economic and this stock market cycle. First of all, let's have a look at the Fear and Greed Index. I have made some videos about this before, and what it tells us is where we are on a scale from extreme fear to extreme greed. And when we are at extreme fear, that is when we should start looking for some buy opportunities. And when we are at extreme greed, we might be taking some risk out of the market, or at least we might not buy as much as we normally would. If we're looking at a historical chart here, we can see going back to the end of 17 here, we can see that this indicator oscillates very much from highs to lows. And you can see here, this was where we had the big drop, the 20-25% drop in the stock market at Q4 in 2018. Then we were at a very low level and we started to look for some reasons to get into the market, and Fed came and helped us right here, saying, yeah, we might lower the interest rates in 2019, and the stock market shot right up here. You can see here we were at an all-time high when we went into 2020. And of course it needed a trigger, but this virus coming and we were shot straight down to a very extreme fear level here. And this was around March, whereas the market has gone up straight since then. So now we are at an 80 level, and that is a level where the market usually takes some sort of downturn. Now it doesn't have to mean a complete crash. You can see here, for instance, I put an arrow. We were at a high level at the Fear and Greed Index here, and we got a quote-unquote crash. It was actually only a small correction of 5 to 7%. Then we got some warning signs here, and the market kept going up, but all of a sudden it didn't. So it is not a perfect indicator. But right now we are at a very, very high level. Now, let's take a quick look as to what this Fear and Greed indicator actually contains. For instance, we have here the CBOE 5-day average put-call ratio, meaning are people buying more call options or are they buying more put options? And when this is low, it means that they are buying more call options. A call option is a way to leverage your money often. If you have $10,000 in your account, you can only buy $10,000 worth of stocks. But if you're using options, you can actually get in a lot cheaper. You might be able to get in at 10% the value, buying some sort of out of the money call because you expect the stock to go up, meaning that you can actually leverage your money. And when you're buying a lot of put options, if that was the case, that is when you really are worried that things might go down. Take a look at here at the beginning of 2020. This was actually before the crash came. The put ratio, or the puts were way higher than the call, meaning that people were really scared that something bad would happen. Right now, nobody's buying put options because put options are an insurance if things should go down, and of course, nothing can go down. This will keep going forever. So why buy put options? This is one of the really scary signals to me. We can also see here we have the S&P 500, and it's a 125-day moving average, just about a half a year moving average. And what you can see here is that the S&P 500 is way above its moving average. And it is kind of like a rubber band moving up and down below and above the 125-day moving average here. And at some point it will get down to this again. Or the price will start to go sideways and the moving average will start to move upwards, and at some point they'll meet each other and it might go even higher. So again, this is not a magic formula. What we are talking about here is statistics. Are we in an area where we should be a bit cautious about the risk we put into the market? And yes, I think we are. What we can see here is a junk bond demand and how much extra percentages we demand to take on some really risky junk bonds. And what we can see here is that when this percentage gets lower and lower, it means that people are willing to take on very risky junk bonds without getting very much extra in performance for it. So right now we are only demanding something like 2.09% more for taking on risky junk bonds, and that shows us that people really don't care about risk. They just put their money where they can get some high percentages, and they are convinced that nothing can go wrong. All right, here's some safe haven demands. Are people pouring money into stocks or into bonds? And right now we can see it's mainly into stocks. We can see how many stocks are making new 52 weeks highs. We can see that is at a fairly high level, but not the same here as when we went into 2020. We can see something called the McClellan Volume Summation Index, where they're looking at the up days and the down days and seeing where are the most volume. And this is also in a positive area, but not extremely high. And again, we can see the index many of you know as the fear index. We can see that is the VIX index, and that is at a low level here, but not as low as in 2019. So that is what sums up the entire fear and greed index. And right now we are at quite a high level, but of course we can go higher, no doubt about that. Now, I have some other indicators, and of course I'll link to all of these below. I found this site called Phil's Stock World. It's actually a very decent site here with some good information. And he's summing up in a blog post here some other market breadth indicators that you might want to take a look at. I'll also put a link to this below. And what, for instance, here he has something called the market divergence growth up. 6-month return on US growth stocks minus value stocks. So here they're looking at there's some definitions down here as to what is growth and what is value stocks. But what they look at is what is going up more. Is it the value stocks or is it the growth stocks? And right now I hear again and again that value investing is dead. And the reason why people say that is that all the growth stocks, all the companies that are not actually producing much value, but they're just going up. And we hear this right now saying value investing is dead. Funny enough, we heard the same in 07-08, where people were laughing at value investors saying, yeah, you must be idiots because everything's going up. Why look at value stocks? We saw the same in up to the .com crash in 2000. And we have seen it again and again and again. Value investing is dead. No, it is not. We are just in an economic and stock market cycle where it is the growth stocks that really are in favor. Then everything went down and people were laughing and said, yeah, you momentum growth stock investors or traders, you must be crazy. Growth stocks are dead. No, they were not. They were just taking a beating. We heard the same in March 2009, where everything just started to go up, and we have heard it again and again and again. So no, growth investment is not dead and value investment is not dead. There are just time for each of them, and right now we are at an extremely high level where the Amazon and the Facebook and the Tesla and all of these stocks are just growing to the moon, even though some of them might actually not turn a profit for quite a while. All right. Here we have the call open buys versus the put open buys. That is the same as the put to call ratio I showed you before, just on the opposite. And here it shows us that the amount of call options taken, where people think the market will go up, so therefore we can leverage our money, that is extremely high, and it is way, way higher than it was, for instance, in 2000 before the .com crash, where everybody thought that this would go on forever. So right now we are at a truly extreme level. All right, what can we see more? We can see the Citigroup. They have this panic euphoria model, where you can see that it is to time tops and bottom, or at least giving us some sort of idea as to if we should pour more risk into the market or take some risk off. And as you can see, for instance, here was just around New Year and in the spring, where it told us we are in the euphoria area. Then we had the big drop here due to the virus, and we went into a panic area where it said, yeah, well, you might want to be looking at some sort of buy opportunities now. And now we are back at a level where you can see when the bubble peaked in 2000, it was at 1.5, but this is the highest level since 2000. So also a warning sign. Now, here we can see something, because I hear this quite often when I try to raise some voice over the concern or my concern that we are a bit highly priced right now, and people are saying, no, it was just because the crash, but it is because the investors can see that next year and the upcoming years will be very good and the companies will start making money. Yeah, well, when you look at the S&P 500's price earnings ratio based on next year's earnings expectations. So this is not this year's, where the earnings have been beaten down due to the virus and the shutdown and all of this. This is the price earning, the forward, where we're looking at what do we expect from next year's earnings. And right now we can see that we are at a price earning, a PE level for the entire S&P 500, which is above 25. We have not seen that since the year 2000, meaning that the price we are paying for every dollar that the companies earn are at the highest level that, well, we haven't seen for a long time. We had the 6, 7, 8, we were actually here at 07, 08 here before the financial crisis, and we were here again at a very high level at around 10, 11, 2010, 2011, where we also had some tough years here. So right now we are at a level that I personally cannot remember that we have been in. I know I have been investing since 1987, but again, financial memory is short and I simply cannot remember it was as crazy as this in 2000, but apparently it is. Now what we have here is the S&P 500 market cap to GDP ratio. And that is an interesting indicator. That is also often called, or it is actually the one down here called the Buffett indicator, but they show kind of the same, because what they show is that how is the stock market doing compared to the GDP of the country. And the reason why that can be important is that we know that the GDP is a measurement of all the products and all the service that is produced in a country. All right, so far so good. Now, it is mainly privately held companies that are producing this GDP. So we must think that when the GDP is growing like 10%, it must be because the companies are producing 10% more services and goods, and they can sell these, and therefore they must be doing better, so the stock market should go up, let's say 10%. This is a very rough estimate, but they should have some sort of correlation. Now, what we could see up to 2000 was that the stock market was going up far faster than the GDP. The companies, the pricing of the companies was so ludicrous that people afterwards were saying, yeah, well, why didn't we see that? And I told you so, and so on. But it actually took 10 years to get down to a level where it could start for real to move up again. But right now, we are at a level where the pricing on the S&P 500 compared to the GDP, and I know that this is because the GDP has been taking a hit due to the virus and so on, but we are actually also before here 2020, we were actually at a level almost at the same as in 2000, and now we are above, meaning that the stock market has gone up so much more in percentages than the actual goods that United States are producing. And that is not a healthy thing. Of course it can keep going up, nobody knows how far, but we are at a level where the rubber band is quite stretched. And you can see here the Buffett indicator is quite the same. He's just looking at the US market cap called the Wilshire 5000, also called the entire market. And as you can see, this is even crazier. We are at a very high level here. So that is also on the Guru Focus, where we can see the chart here I normally look at. And it tells us that right now, When we are between 114 and 135% ratio, we are modestly overvalued. Above 135%, we are significantly overvalued. And right now, we are at a level called 187.8. So we are extremely overvalued right now compared to the stock market. Does it mean it will drop? No, at some point, yes, but we don't know when. All right, let's have the last couple of things here. This is the cash and customers' cash and margin accounts. So this is how much cash we are actually holding in cash, whereas the rest is out in the market moving. And as we can see right now, we are down somewhere around 1.5% of the entire customers' money in cash, meaning that almost every single dollar is out in the market working. We haven't seen this level if we just if we don't regard here in 2017. We haven't seen this level. We saw it in 2005 here, and we saw it just before the dot-com crash, meaning that was times where the market were overly optimistic and euphoric, and it needed to have some sort of retracement. So we are at the same level here. There's not much money left on people's account to keep the market up. When we were here and in the spring of 19, we could see that there was quite a lot of money in customers' account, so there was a lot of money to pour into the market. Right now, there's not much money left to keep buying. So let's see where that ends. And there are some bets against the US, and there are some more numbers here. I think you get the picture that right now we are at a time in the economic and the stock market cycle. They're not necessarily the same, but the stock market cycle where everything is completely overbought. But again, for the 10th time in this video, that doesn't mean that the stock market will drop tomorrow. It can go up 50% more. It can go up 100% more. So I'm not telling you to sell. What I am telling you is to be careful with your risk. Right now, and this is my personal opinion, and I'm not giving you financial advice because I'm not a financial advisor, but right now, I'm not taking on extra risk with options, for instance. Or if I'm using an option, I'm only using an option where it is backed by cash in my account. So it is just an easier way to get a position in the market, but I still have the cash parked in my account so that I can easily get out of my option position. So right now, I'm not using any sort of leverage. I'm not using it on CFDs or anything. Right now, what I have in the stock market is my own money, and actually I have gotten some sell signals on my different accounts. So right now I'm somewhere between 70 and 90% invested in my different accounts. But that could go to 100 again. If I get buy signals, I buy, but I don't take more risk. In the spring, when everything started to go up, I started to take on some more risk. And in my US accounts, I was using options to leverage my stock holdings, simply because we were at a point also from all of these points of view here in the articles here, all the graphs were showing me that there was a huge potential for some upwards movements. I'm never taking 3 or 5 or 10 times leverage, but it could be 1.25 in leverage. So I'm putting a bit more money in that I have, but not much. Now, the thing I have been hearing, and that is something that really scares me a lot, is this quote. And that will be the last quote you hear from me today. And that is from Sir John Templeton. If you don't know who he is, you should definitely look it up. It is a big part of your financial education. But what he said was the 4 most expensive words in the English language is, or are, this time it's different. And believe it or not, the last month or so, I have heard this several times. I have seen this in several Facebook posts, that just remember, we are in a situation we have never been before. The interest rates have never been so low. There had never been so much money printing, and so on and so forth. So this time it's different. So of course, we will not have a big crash now because we are in a state of a constant bull market. Believe it or not, I heard an economist saying that, or he wrote it in an article, that he believed that the central banks of the world have learned so much that they could keep the interest constantly low and the world in a constant bull market. Well, the only bull in this is the bull in BS, because this is not going to happen. We are not going to see a forever bull market or a forever low interest rate. We might see it for the next 2 years or 5 years or 10 years, I don't know, but it will revert. All right, that's it for now. I didn't mean to scare you with all of these graphs, so I hope that when you get your buy signals, you keep buying, because it can go up for a long time. But be careful and don't over leverage. That is 100% certain way to lose all of your money when things crashes. That's all for now. Take care of yourself. Take care of your money out there. I'll talk to you again very soon. Bye.